Welcome back. Today we're looking at an analysis of Opendoor's Big 2.0 strategy.
Huge news here, with Lucas Matheson starting as president today.
Exactly. The report covers his plan to pivot to an AI-driven, tokenization-focused model. It's a strong piece, but we think it can be even sharper by really digging into the execution risk.
Right. The strategy itself is fascinating, but the connections, the logic tying it all together, that's where we can add some real depth.
Let's jump right in. The first point is about Matheson himself. The report is bullish on him, which makes sense, but the analysis needs to more explicitly bridge his specific regulatory experience with the, frankly, huge execution risk of tokenized housing.
That's the core of it. I mean, the report correctly highlights his background. CEO of Coinbase Canada, M&A at Shopify, that all sounds great.
Skills directly tackle the massive U.S. regulatory hurdles for creating a liquid, tradable asset out of real estate.
It's a huge leap of faith, the connection between his profile and the blockchain mandate. It's presented more as a given than as a deeply analyzed solution.
And we know the real challenge isn't just tech. It's regulatory, right?
Absolutely. You're talking about fractional ownership laws, securities implications. The U.S. digital asset space is a minefield right now.
So the weakness isn't that his skills are irrelevant, it's that the report doesn't connect them to the specific roadblocks he's going to hit in the U.S.
Exactly. So the suggestion is to dedicate real analytical space to projecting which regulatory hurdles Matheson is, uniquely positioned to solve.
That would make the whole thing so much more credible. It would justify the board's confidence.
For sure. So instead of just saying M&A at Shopify, maybe analyze what kind of M&A challenges a tokenized system creates. Is he buying fintech talent, regulatory licenses?
Ooh, that's an interesting angle. Treating his past not just as a resume line, but as a specific toolkit for this job.
Precisely. And with the Coinbase Canada experience, Canada's regulatory environment for crypto is very different from the U.S. The analysis needs to justify why his success there is portable here.
Especially with how aggressive the SEC is right now.
Right, so you could even have a small subsection, something like regulatory bridge, applying the Coinbase model.
I like that. That would force the analysis to connect his expertise directly to overcoming specific obstacles. Maybe like how to classify these assets so they aren't immediately slapped with a restrictive securities label.
Yes, it moves the report from just summarizing his CV to analyzing his actual strategic function. If tokenized housing is the moonshot, Matheson's regulatory strategy is mission control.
And if you don't analyze mission control properly, the whole premise feels shaky.
Exactly. The report needs to be as rigorous as the challenge itself.
Okay, that brings us to the second point, which is more about the structure of the report itself. I noticed the risks are kind of siloed off from the main strategy discussion.
Yes, and to provide a more robust and constructively skeptical assessment, the analysis should really integrate those key risks directly into the discussion of the strategic pivot.
It's a critical point. The report identifies some huge risks. I mean, a valuation gap of 1.3x price to sales versus a $3 fair value. That's massive.
And high execution risk, interest rate sensitivity, but they're all tucked away in Section 4, separate from the more, bullish narrative in Section 2.
Which kind of diminishes their impact, doesn't it? It lets that buying the vision sentiment just run wild. And the stock is up, 320% year to date?
Exactly. The market is running on pure optimism. And by separating the risks, the report ends up feeling like a strategy piece with a disclosure, not a strategy piece constrained by risk.
That's a great way to put it. The execution risk isn't a footnote. It is the immediate context for the entire strategy.
Right. So the suggestion is to reframe the material. Use those financial and execution risks as the lens through which you view the strategy.
Challenge the market's valuation from the get-go.
Yes. That valuation gap, for instance. The stock is trading at more than double its fair value. The market is paying for a vision. The report needs to hammer home that this isn't just a metric. It's the central tension of the whole story.
And that tension gets lost when the risk section is 2 chapters away.
For sure. So a concrete example would be to follow the description of tokenized housing immediately with the associated execution risk. Frame it as a direct constraint.
Or even restructure the market sentiment section. Bring that valuation disparity right up to the front.
You could argue something like, the current speculative market, with the stock at $6.36, is buying a vision that requires flawless execution. This places the stock significantly above its $3 fair value, highlighting the enormous stakes of the Matheson transition.
That framing immediately sets a more critical, authoritative tone.
It does. It shows the analysis is not just describing the strategy, but actively challenging the market's response to it. It forces the reader to be skeptical.
Which is exactly what you want in this kind of high-level analysis.
Absolutely.
Okay, so let's move on to the strategy itself. The report breaks it down into two main parts, the AI-driven velocity on one hand and the tokenization goal on the other.
Right, and that leads to our third point. The analysis would benefit from synthesizing the operational efficiency from that AI-driven velocity with the ultimate strategic goal of tokenization and liquidity.
I see. So right now, it treats them as two separate things happening at the same time?
Pretty much. They feel adjacent, but not deeply connected. The report talks about doubling the weekly pace, tighter spreads, great efficiency gains, and then it talks about the fintech pivot.
But the link is missing. The why. Why is that operational speed a prerequisite for the digital asset platform to even work?
That's the core weakness. If your new identity is a fintech marketplace, you have to show how your old iBuying operation is the supply chain for that marketplace.
So the AI-driven shift isn't just about cutting costs. It's foundational to the entire pivot.
Exactly. Think about it. The high volume and tight spreads, that's what allows Opendoor to turn illiquid houses into a consistent stream of inventory. That's the only way you can create a large, credible, and most importantly, liquid pool of tokenized assets.
Ah, so the AI velocity isn't just an efficiency gain. It's the raw material for the new business model.
It's the input. So the suggestion is to explicitly analyze that synergy. You could focus on the concept of scale for liquidity.
You could make the argument that high-velocity acquisition isn't just about efficiency. It's the factory floor, producing the volume needed for tokenizing assets at scale.
Yes, that's perfect phrasing. It's what mitigates the inherent illiquidity risk of any fractional real estate asset.
Because illiquidity is the #1 killer of any tokenized asset, especially something like real estate. The only solution is massive scale and consistency.
So the AI system is directly feeding the fintech model. The report needs to connect those dots. Maybe even have a subsection titled Volume as a Prerequisite, how AI velocity fuels tokenized liquidity.
I like that. It ensures the operational side isn't seen as just a cost-saving thing, but as a mandatory part of the new business model. Without the velocity, the tokenization model just falls apart.
And that level of synthesis just makes the whole analysis so much more comprehensive and logical. It really captures the complexity of what they're trying to do.